Okay, so if you've logged into pretty much any major application at work, chances are you've used Okta. They're like the digital bouncer for thousands of companies. But here's the thing that just doesn't add up. While Okta is literally everywhere in our digital lives, on Wall Street, its stock has been getting absolutely hammered. So today, we're going to dig into a deep dive research report to figure out what is going on. Right, let's just get straight to it. This is the central mystery we're trying to solve. Why is a company that's so critical to modern business watching investors run for the exits? To get to the bottom of it, this report lays out two completely different stories. The story the market is telling itself, and the one that's kind of hidden deep inside the numbers. All right, first up, we have to understand the bear case. What are the red flags that have investors so spooked? What's driving this negative narrative around Okta? Well, it really all starts with one very important number: 11%. That's how much Okta's revenue grew in its most recent quarter. Now, you might be thinking, hey, for most companies, that'd be fantastic. But for a tech giant like Okta, that is the slowest growth rate they have ever posted since they went public. And that slowdown, well, that's the headline fear that has sent shockwaves through the market. And you can see the fallout from that slowdown right here. This table basically shows how much investors are willing to pay for each dollar of a company's future revenue. And just look at the difference. CrowdStrike is trading at a multiple of 22, Palo Alto is at 11, and Okta, it's all the way down at 4.5. The market isn't just punishing Okta, it's valuing it like it's in a completely different, much slower league. And it's not just that one growth number either. This whole bearish story is being fueled by a bunch of other signals. For one, you've got top executives who are consistently selling off large chunks of their stock, which, is never a great sign. Then there's the broader economy, with CIOs everywhere trying to slash their budgets. And looming over all of it is this big fear that some new advanced AI could come along and make Okta's entire business model obsolete. Okay, so that's the gloomy picture. That's the bear case. But this research report makes a powerful argument that Wall Street is totally focused on the wrong story. It claims there's this really strong bull case hiding just beneath the surface. You just have to look at the numbers behind the headline numbers. And this slide, this captures the entire counter-argument perfectly. See, the market is laser-focused on today's slowing 11% revenue growth. But the report says, hey, look over here. Look at the backlog of future contracted revenue, because that's actually speeding up, growing at 15%. So that backlog has a name. It's called RPO, or Remaining Performance Obligations. Honestly, the easiest way to think about it is like a restaurant's reservation book. Today's walk-in business might seem a little slow, but the book for the next few months is totally packed. Well, for Okta, that reservation book is worth a whopping $4.8 billion. So while the current revenue might look a little weak, the pipeline of future business, it's stronger than ever. Now, the second part of this bull case is this pretty incredible turnaround in profitability. Just look at this chart. In fiscal year 2025, Okta had a negative 3% operating margin. That means it was literally losing 3 cents for every dollar of revenue just to keep the lights on. But then in fiscal year 2026, that completely flips to a positive 5% margin. The company has quietly gone from a cash-burning machine to a sustainably profitable business, and that is a massive shift that the market seems to be completely ignoring. But here's where it gets really interesting. The report's biggest argument isn't even about the past, it's about the future. It claims that AI, the very thing the bears are so afraid of, is about to become Okta's single biggest opportunity. This quote from the report just nails it. It perfectly describes this huge new security crisis that's brewing. You see, companies are deploying these armies of autonomous AI agents to write code, to make sales, to run operations, but they're trying to secure them with tools designed for people, and it is heading for disaster. And this isn't some theoretical, far-off problem. The report actually lays out a timeline of what these failures could look like, giving some pretty plausible near-future scenarios. A coding agent just goes rogue, a massive data breach caused by an AI sales tool, and even state-sponsored cyber attacks powered by AI. This new threat is on the horizon, and it is coming fast. So what does all this create? Well, the report calls it shadow AI. Basically, countless artificial intelligence agents operating inside company networks without any security, without any governance. And the cost? It's staggering. The report points out that just the presence of this shadow AI adds, on average, over $500,000 to the cost of a data breach. So, of course, this is where Okta comes in. They are about to launch a brand new platform, Okta for AI agents, designed specifically to solve this exact problem. It goes in, discovers these rogue agents, gives each one a unique identity, and then enforces really strict security rules. It's essentially bringing law and order to the Wild West of corporate AI. So here we are with two totally conflicting stories. On one hand, you have a company that's slowing down and facing new threats. On the other, you have a profitable company with a growing backlog that's about to jump into a massive new market. So which is it? Is Okta mispriced, or is it just fundamentally misunderstood? And here it is, the whole debate in a nutshell. On the bear side, you've got the slowing growth, the insider selling, and this new threat from AI. But on the bull side, you have an accelerating backlog, newfound profitability, and a huge first-mover advantage in securing AI, all while the stock is selling at a massive discount. So after weighing all the evidence, where does this research report land? Well, it comes to a very clear conclusion. It is decisively bullish on Okta's future. And here's why. The crucial point of the report is that the market has it all backwards. This new wave of agentic AI isn't a threat, it's a massive tailwind that will force every company to buy more identity security. The rock-bottom valuation gives investors a huge margin of safety, that growing backlog puts a floor under revenue, and hey, its low price even makes it a prime target to be bought out by a larger company. And that really leaves us with the ultimate question, doesn't it? This report makes a really compelling case that Okta's stock is priced for a total disaster. At the exact moment its biggest opportunity ever is about to arrive. So the question for everyone is the market truly missing the signal here? Or is it just seeing the risks a lot more clearly?